So, thank you very much. And Kurt, may I hand over the chair to you, and Stefano is arriving in just a second.
Thank you very much, Jos, and thank you for facilitating my job as Master of Ceremony and of this panel. I really would like to welcome my fellow panelists. Colleagues, and friends, we see an increasing interest in carbon pricing. This has been discussed since yesterday. We see many initiatives on carbon pricing popping up across the world. We heard from people like Kurt van Dender and Caroline also this morning that there is an increasing trend of carbon pricing. It's maybe not surprising because we need that for realizing our climate ambition. Economists tell us since a long time that carbon pricing is the best possible economic tool to achieve our climate goals. And I believe that we can say also within Europe that we have shown that carbon pricing through the emission trading system works. It actually delivers. Recently in March, we have celebrated the 2,500 auction since 2005. We have reduced emissions thanks to ETS in those sectors by more than 35% since 2005. And interestingly, as was also pointed out this morning, it has generated revenues of 142 billion euros since 2005, of which 38 billion we estimate in the last year alone. So that gives you a sense of the proportion of what ETS is doing. So it's the core policy instrument of our climate policy architecture. I would call it our workhorse. It's really our workhorse for delivering on our climate ambition. But Europe is not alone. We really would like to see the rest of the world to have similar workhorses. And that's what we will discuss in our panel here this afternoon. This session will serve to hear a little bit what are the range of instruments and what perspectives there are on carbon pricing across the world. What we have learned through these many years of experimenting with the cap and trade system is that, first of all, political will over a sustained period of time is very important. It's the long-term predictability and trust that makes investors and economic actors take the decisions that we want them to take. And secondly, the design is so important. It is complex. It is very complex. It needs adjustments the whole time. You need to monitor day by day what is happening. And it's fair to say that Europe didn't get it right from the start, right, Jos? It has taken us quite a few years to really come to the point where we are so confident that we can say we can extend this beyond industry and power to buildings and road transport, for example. So this afternoon we have here a couple of very distinguished experts and practitioners, if I may call you this way. We have Stefano De Clara, head of the Secretariat of the International Carbon Action Partnership, a partnership of 40 jurisdictions, and I'm told you do outreach on carbon pricing and tracking progress. You will present ICAP's latest report on existing and new initiatives. And the good thing about, and among many others, about this meeting here is that you get to know so many different people and initiatives that exist. That in itself is such a value. We also have Kelly Kizier, who will join us online. I hope the connection works. Kelly is Director of Corporate Action and Markets at the Bezos Earth Fund. Importantly, and we say this with some pride, Kelly was also a former colleague at DG Clima. So DG Clima and the Commission is sending out its sons and daughters across the world. And I'm sure Kelly will give us not only an American perspective on carbon pricing and what this IRA is all about, but also the work that is done now on the energy transition accelerator that John Kerry is often talking about, and we would want to learn a lot more about this. And then we have two climate ambassadors with us. Welcome, Catherine. We already had a quick talk this morning. You are Canada's climate ambassador, and we know a lot about, or we have heard a lot about Prime Minister Trudeau's global carbon pricing challenge, and I'm sure you will tell us much more about that challenge. And Kay Harrison, welcome also. You are New Zealand's climate ambassador. We talk a lot now about how we can cooperate between the EU and New Zealand, so we'll be very keen to hear from you what you expect from COP28, but also carbon pricing in that context. And last but not least, we have Guy Turner. Guy, you're there. You have more than 30 years experience as an analyst and a strategist on sustainability and energy transition. You founded your own company, Trove Research, which is great to see that climate policy is also leading to businesses, to new businesses. You are extremely well versed, I'm told, in voluntary carbon markets, which is hotly debated since yesterday. So I'm sure you will tell us a little bit what works and what should work better in the space of voluntary climate markets, carbon markets. But first of all, let us turn to Stefano, and we're keen to hear about your reports.
Great, and I'll happily do that. First of all, it's a pleasure to be here as always. I hope you can hear me okay. And I can guarantee that you're not the only one that has this event pretty high on its agenda. I think most of us look forward to be here year on year, because it is one of those events where we all learn a lot from each other. A quick point on ICAP, as you pointed out, we are a partnership of 40 different jurisdictions that get together and work jointly on ETS implementation. And I wanted to specify that as what I will present now will be the state of play for emission trading systems globally, and then I know that we will go more broadly than that in the panel discussion later. There are three key trends and observations that I wanted to tease out if we look at what happened in the world of emission trading systems over the last 12 months or so. First and foremost, and it's not an obvious point to make at this point in time, is that the momentum for ETS development and implementation is continuing, and it's not losing strength. We've done this assessment for 10 years now, and it's quite staggering to look back at what the situation for global ETS was a decade ago. And over the last 10 years, the number of emission trading systems in operation more than doubled, and so did the share of global emissions under an ETS cap. So significant expansion over the last decade and over many different crises, as you pointed out, which did not counter the momentum behind ETS implementation. Second, and coming to last year, ETS worldwide did survive and did weather an eventful year characterized by the first ever global energy crisis pretty well. As you pointed out, they learned from previous mistakes and past crises. They were made more resilient over time. Policymakers and government officials provided reassurance and remarked on the roles that these systems will have going forward, and that really helped ETS systems across the globe to survive and to weather a significant crisis much better than most of us anticipated at the start of last year. And this is a really strong showing of resilience and strength by most of the global emission trading systems. on the back of this, carbon prices remain largely unchanged year on year, meaning that they opened and they closed 2022 roughly at the same levels, which again was not trivial considering what 2022 brought to the global economies and to the global market. Prices did fluctuate across the year, as we will see in a second, but overall they provided to be stable and resilient, and systems did keep on raising record revenues. 2021 was a record year for ETS revenues, and 2022 continued on that note, breaking even the previous record, and we'll go into that in a second. And we'll start to unpack the key trends now. So this is where we are with ETS worldwide. The map shows systems in operation as of today in blue, and then systems under development or under consideration in the two different shades of green. We could easily spend hours unpacking what's on the map here, but like one thing worth noting is that first of all, the EU ETS is not the only show in town. Obviously, it was back in 2005, but since then, the concept and the implementation of emission trading systems proliferated across almost every continent. For the first time last year, Africa came on the map, as systems are being considered in more and more geographies. And this map is also increasingly becoming more and more populated every year, as countries get serious about NDC implementation, and also as they get pushes to implement emission trading systems from different drivers, including CBAM. I think we are likely to see this map to change quite a lot and quite rapidly over the coming years as a result of the signal that CBAM sends to countries globally, and we're already seeing that as jurisdictions get more serious about ETS implementation. We've got 4 more systems coming online in 2022. This follows, again, a decade and more of a trend where new systems are added every year, and where every year the global coverage of ETS gets expanded. We are now in a situation where we have 29 systems in operation, and many more underway, either as under consideration or under development. And it's also worth noting that 1/3 of the global population now lives under an ETS in force, and jurisdictions making up 55% of global GDP are using an ETS to cover some sectors of their economy. And again, that's a strong showing of what role ETS play in the global decarbonization efforts. Delving a bit more into the details, I think it's also quite interesting to see what sectors are covered by systems worldwide. And there was a lot of discussion over the last day and a half on sectoral expansion and expanding the reach of carbon pricing and emission trading systems to new sectors. So I think it's quite interesting to see, as of today, what different forms ETS can take and what sectors they can cover, depending on the use that jurisdictions want to make of those instruments, and also obviously depending on the emission profile of the jurisdiction that is implementing an ETS. The 2 shades of blue are power and industry, which are covered by almost every sector. But over time and in different systems, additional sectors came in and are covered. We're looking forward to also add a maritime circle when that will become operational, and obviously this plays a key role in the decarbonization effort, and in exposing more and more sectors of the economy to a carbon price. Looking more closely at the carbon price itself, on the left-hand side of the slide, you can see how prices evolved over the last 15 years or so, and then on the right-hand side of the slide, you can see how they performed in 2022. What's worth noting is that over the last 3 or 4 years, prices did increase significantly across the board and across most systems. And as Kurt also pointed out in the introduction, this is largely due to reforms that put more ambition on the table in different jurisdictions, and also on the back of the more ambitious commitments that countries brought forward in the run-up to COP26 in Glasgow, and that really sent a signal that increased prices across the board in many different systems. And then on to 2022, where we see that as a result of the energy crisis, prices did fluctuate, but overall they remained stable, and they proved to be really resilient in the face of the major crises that affected the global economies. These prices and prices that have been relatively high over the last couple of years did raise a record level of auctioning revenues. As you point out, Kurt, we did break a few records in Europe, but also elsewhere. Since the first auction took place all the way back in 2008, more than 220 billions were raised globally in ETS revenues, and out of these, more than 60 were raised last year alone. And if you take the last 2 years combined, that is more than 50% of the grand total. And again, that is a consequence of higher prices, increased use of auctioning as opposed to free allocation, which brings in auction revenues, and especially at the time of an energy crisis, these revenues are crucial to protect consumers and covered entities, as well as to further climate action beyond the borders of an ETS. And the last point I want to touch on, and I will close on this slide, is the relationship between ETS and the energy crisis. And I apologize for closing the presentation on what is a relatively hard slide to read, but I'll quickly take you through this. So, in a nutshell, we wanted to understand what was the relationship between ETS and the energy crisis. We plotted on the graph here the consumer price index, which is basically an index that reflects the cost of a standard good of a standard basket of goods that a family needs, and that is the blue line. We also plotted the energy component of it, so the energy component of the overall consumer price index, which is in orange, and then we also plotted the allowance prices in the relevant systems, and we centered the graph on the 1st of January 2022. So that shows you the pre-energy crisis and the post-energy crisis scenario. And as you can see, and as we all know, the consumer price index grew quite a lot over the course of 2022. This was driven by the energy component of the carbon price index, because as we all know, we were in an energy crisis situation which sent up consumer prices. But what's worth noting here is that the allowance price instead remained largely stable or stagnated, and did not contribute to the increase in the energy cost, or eventually in the increase of consumer price indexes. And this shows that allowance prices and carbon pricing in general did not contribute to worsen the energy crisis, and if anything, they gave relief at a time when other components of the prices that consumers face were going up. And we all know that it's quite easy to blame carbon pricing for all sorts of things, but if you look at the data, this was not what contributed to worsening the energy crisis and imposing more burden on consumers. And what we put on the slide is the trend for Europe, but if you look at the smaller ones, you overall see the same trends in most systems globally. And yeah, I think this was an interesting message out of 2022, and I'll end with this one. Thank you for the time, and I'm looking forward to the discussion.
Great, thank you very much, Stefano. This is a very upbeat message for ETS practitioners and advocates, I'm sure. Thanks for your insights, especially the last one is a very useful insight, that carbon price did not contribute to making the energy crisis worse. That's really something that we will need to take back home and chew a bit on and see how we can use that insight. Thank you, Stefano. Let's turn to Kelly, who joins us online. I hope the connection works. Kenny, we'll be very keen to hear a bit your perspective from an American standpoint, but from someone who knows European climate policy much better than many, I guess, in the US, as you have been working in DG Climate, as I said. So over to you.
Yeah, thank you so much. I am having a lot of system problems, so could you just maybe go to the next panels and come straight back to me, because I'm joining from cell phone, but my system seems to be in meltdown. Just give me 2 minutes.
So let us turn then to Catherine. Thanks for being here, Catherine. You've heard the upbeat message from Stefano. This must be music to your ears and that of your Prime Minister. So we're very happy to learn more about the global challenge.
Thank you. Thank you very much, Kurt. And thank you to Josh and to EUI for having me here. And I guess before I get into the carbon pricing, the global carbon pricing challenge, I'll speak a little bit to Canada's experience in addressing climate change, just to give you some context. We in Canada have an NDC of 40 to 45% reductions of emissions by 2030 compared to 2005 levels. And since 2015, we've introduced over 100 different measures and invested over $120 billion in climate action. And we have a lot of different things, different tools that we are using to address climate change in Canada, including coal phase out, clean electricity regulations, and we also are looking at zero emission vehicles. But in addition to that, carbon pricing. And you use the word workhorse for the EU. I would say for Canada, carbon pricing is also very much a cornerstone of our climate policy, and really encouraging to hear the upbeat message that Stefano was just delivering, because we do feel that there's a strong evidence base developing in terms of the potential of pricing. But the experience in Canada has not been an easy one, and as many of us have expressed, there are those challenges. And for our part, the carbon pricing policy has been taken to the Supreme Court twice, and it has been upheld. We've also had federal elections, 2 campaigns, which have very much had carbon pricing as one of the top issues of debate. But those elections have since been won, and carbon pricing, has been something that is sticking. And as you mentioned, Kurt, to have it continue to deliver over a sustained period of time is really key. So we feel, given our experience with carbon pricing, that Canada is well placed to engage in discussions on our experience. We, back in 2016, brought forward our Pan-Canadian framework, which is our approach in bringing together all 13 provinces and territories, Indigenous communities together to advance a carbon plan. And we've since presented other plans, including our emissions reduction plan, to support all the implementation that we need to do. And we feel that we are well placed to talk about carbon pricing. We certainly recognize it for its flexibility, the efficiencies, and the revenue return, which was mentioned. And in Canada's case, 90% of the revenues are returned to households. And 8 out of 10 households receive more than they actually contribute to the system. We also use the revenues to support programs with small businesses, with Indigenous communities, and so on. And the system that we have in place in Canada is not prescriptive on how carbon pricing should be done, but it says that carbon pricing must be put in place. And we have put in place a federal benchmark, which needs to be met across the various jurisdictions of our country. So we think, carbon pricing has a lot of potential, and the more jurisdictions that adopt it, the more efficiencies and the more opportunities that presents. And we also feel that the EU's experience has been incredibly instructive for us, and good to see other ETS experience that's happening that we can continue to learn from. So over to the Global Carbon Pricing Challenge, the GCPC. Hate to throw another acronym out there, but that's how we're calling it. So the GCPC is something that Prime Minister Trudeau launched at COP26, and just noting that 20 to 23% of emissions are covered under some kind of carbon pricing regime globally. His challenge that he's put out there is to bring that to 60% by 2030. And at the leader level, this challenge brings together jurisdictions across the world to demonstrate the strengths of carbon pricing, the potential of carbon pricing, and so on. And it also will help to facilitate technical discussions to identify what are some of the gaps that are out there in terms of knowledge, what are the experiences that are working, where are the challenges that need to be worked on. And we're hoping that this challenge will be very complementary to the work of organizations like ICAP, to the Carbon Pricing Leadership Coalition, Carbon Markets Platform, and so on. In terms of the Global Carbon Pricing Challenge, there still remains scope in shaping what that challenge will be, but it focuses on countries that have pricing in place or commit to pricing. It also focuses on expanding the systems that are currently in place, but also supporting emerging systems. And it also focuses on explicit pricing. And we see this as a very cost-effective, efficient tool, but has that potential as well to decarbonize and also to address distribution, so through that revenue return that I mentioned, and that's part of the policy mix. We have a lot of very interested countries in what we're doing so far, including New Zealand, Germany, the EU, Chile, but we're looking to expand this, and we really feel it's important to be bringing in more partners from the Global South as well, because we don't want to just have the impression that this is a developed country only solution. We feel it's a solution globally, and we're looking at ways of how we can better support countries in the developing world. So we held our first technical working group back in April in Washington to kind of get things rolling under this challenge. And already we were able to tease out some key areas of focus for the challenge. One of them, of course, being that ability to be able to engage in high-level dialogues and give maximum visibility to the validity and the value of carbon pricing. But the other one is advancing country-to-country technical assistance. We know there are a number of countries that are very interested in expanding or starting their own systems, and this could be a potential opportunity to help bridge the demand with the supply in terms of technical support. So we all know, just in concluding, that collaboration is an essential part of this. And if we want to stay within 1.5 degrees, which we must do, we have to be looking at all the tools in the toolbox. And we really feel that carbon pricing has so much potential. But we need to start now to ensure better understanding, better literacy across the board on carbon pricing, so this can be better supported as a critical solution. Thank you.
Thank you very much, Catherine. And we from the EU side are strong supporters of the challenge, as you know. And President von der Leyen has asked us to make sure that we can join the challenge formally. So we're working towards that, because it's really a very good challenge for the world to have. Before we turn to Kelly, maybe I would propose we go to Kay to hear the perspective from New Zealand.
Thank you.
You have quite some experience with carbon pricing as well. So any lessons you have for us, but especially also to know how we can spread it more across the world in the context of the challenge or the COP. That will be very useful insights.
Well, thank you very much, Kurt, and it's a pleasure to be here. And congratulations to the EU on those wonderful statistics that you shared with us at the beginning of this session. And you said two things, that the ETS is about experimenting and it's about political will, and I think both of those things are critical elements. And it's not easy, and yet, you know, I feel torn between the fact that we're in an urgent crisis and how long and how hard it was to get an ETS, which is not yet perfect. So, nevertheless, the New Zealand ETS began back in 2008, 2009, and it was an all sectors, all gases design. And I mean all sectors, all gases. 100% of our emissions were to be covered by it. It also included a couple of unusual elements, a disincentive for deforestation. When we have a beautiful country with about a third of the forest protected, and so not exposed to that kind of possibility of deforestation. So we're not talking about deforestation as you might see in other parts of the world, but we did have privately owned land that was in forest, and if it's land use change, that would be a significant emission source for us. So we included a component in our ETS that would disincentivize land use change and result in a liability under the ETS, and also incentivized afforestation as well. And in that case, we thought, well, this is useful, and for the first Kyoto period, that probably covered our transport emissions, for example, through removals. We also included all liquid fossil fuels, so upstream transport and everything has been covered in our ETS, coastal shipping, aviation, domestic aviation, all since about 2010-12. Our objective was then to deliver in a Kyoto world with a Kyoto global cap. We have an economy that's a profile that is 50% agriculture, high renewable energy, around about 80 to 90% renewable electricity generation. So it was rational for us to trade within the Kyoto system and to operate an ETS to pass through the cost, but we weren't in the business of driving down our own emissions because they would be significantly more costly. But post-Kyoto world, we're now in the situation that we're all in of transitioning all of our economies. So we changed our ETS to be somewhat more conventional, to include its own domestic cap and auctioning, and that wonderful thing, revenues from auctioning, that we can recycle into our transition. We're still grappling with the last 50% of our emissions because it's one sector, and that's agriculture. As I always say many times whenever I come to this institution, agriculture in New Zealand is not subsidised, and it will be priced. By law, if a suitable design has not been agreed between the sector and the government, it will automatically join the ETS as a liable sector in 2025. And that means 100% of our emissions would be covered, or nearly 100%. the questions now arise if our settings are right. So once again, we have to adapt. As the prices got higher, as it has around the world, forestry has become really attractive and really profitable. And at the same time, we're not delivering the reductions in gross emissions that we would like to see. And so we are reviewing the ETS again to think about whether the forestry, how to manage the forestry component to give us the things that we want from it. We also need to consider the relationship between our ETS and our NDC. We have an NDC of -50 by 2030. Much of it will need to be delivered through cooperation internationally. Nevertheless, we have our emissions trajectory and pathway to our domestic zero locked in by law, but we supplement that. We'll need to supplement that through cooperation. So when it comes to COP28, what's its role? Well, of course, it's going to solve everything, you know, like all of the other COPs have. And it's odd when you live in that kind of echo chamber. It's quite a large echo chamber, 40,000 people sometimes, but it is an echo chamber where we think we kind of solve things. And really all we can do is send united and adamant signals to you all and to us all. And the basis for that has got to be the science. And so thing number one is we were given AR6, which is a blessing and a curse. So excellent science, very clear messages. It's absolutely in our hands what we both need to do and what we can do with respect to ambition and action. But it's really clear we're not on track. You know, this will be the end of 2023, and this is the critical decade. But fortunately, we do have the global stocktake. We have a moment that we have designed to pause and look at our performance. And hopefully, we will as those participating in this, find the means to deliver that significant course correction that will put us on track to -50 by 2030. But we're struggling with all the three Paris Agreement goals. And this is where, you know, when I started in the Paris process, I was in Article 6, well, it was before it was Article 6, carbon markets. And I couldn't understand why people didn't understand that this was the centre of the universe. You know, they used to, well, I think they thought we were a bit weird. And, you know, perhaps we were a little quirky and very difficult right until Paris. But if you think about it, and the three goals of the Paris Agreement, domestic carbon pricing, which we've been talking a lot about, is going to deliver the incentives for real behaviour change in real economies, and it's going to generate real revenue to scale that up. Article 6 markets and cooperation can enhance the ambition of every Paris party, if only they will do that. And this is where I will beat my drum about it's not okay, particularly for developed countries, to say, but we're doing everything we can in our own economy. You should also be doing stuff in other economies. That enhances ambition beyond your domestic transition, and it provides that finance flow particularly into developing countries. And thirdly, of course, is the role of the voluntary carbon market. We have got this opportunity, particularly as governments, and we can use COP to do this too, to grasp all of the ambition and will and greening of corporates and channel it to the markets. That private sector that wants to be net zero and wants its supply chain to be net zero needs to have access to markets. So as I said, it was always surprising to me that people didn't understand that markets in Article 6 was the centre of the universe and the centre of an engine room for Paris Agreement action. I guess we'd hoped by now that more of us would be linked and there would be this great global market, and instead we're back at this time where there's this basic divide between shall we price or shall we subsidise the behaviour we want. And there's a degree of retreating back behind our walls to protect our own patches. And so we have a job to do in sharing our experience of carbon pricing. And it's great that Canada is leading the way with the global pricing challenge, because this is the good story and the good news, and we need to get on with it. Thank you.
Great, thank you very much, Kay. And there are being alliances made here as we speak for climate ambition and global coverage of carbon pricing. We in Europe are very intrigued what you do with agriculture. And we will look at this very, very carefully and learn a lot of lessons from you, because we also need to know what we will do with agriculture and land use in the future. Guy, if you agree, I will first go to Kelly, invite her to come in, hoping that the connection and the system now works. Kelly,
I hope so. Can you hear me?
Yeah, we can hear you, we can see you, and we're all ears.
Excellent. I have to say, I wish I was there in person. I think the meeting you were at is one of the highlights of the climate agenda every year. Unfortunately, it clashed with a funders table that I had to go to in New York, which now I resent even more, because it seems to have come home with a virus, not COVID, a computer virus this time. But I wish I was in Florence, as I'm sure you can all imagine. But that's not what I'm here to talk to you about. Instead, I'm meant to talk to you about the Energy Transition Accelerator. So at COP 27, the State Department, the Rockefeller Foundation, and the Bezos Earth Fund announced that we would be working together to develop something called the Energy Transition Accelerator, the ETA. The ETA is a market-driven initiative that we hope will do just what Kay was talking about, leverage the growing demand for high-quality carbon market mechanisms, or even specifically carbon credits, depending on how we develop these, to scale up finance for the energy transition in developing countries. The aim is to launch the ETA at COP28. Obviously, we have our work cut out for us, and in order to launch the ETA at COP in a few months, we've enlisted the help of many, and I'm sure some of these names you will recognize, and certainly recognize from my background in the EU and my background in the trenches with Kay on Article 6. We go to the people we know, right? So central to the effort helping us are Angela Trey-Kalhauge's team at EDF, but Angela was at the Swedish Energy Agency and was part of the EU delegation to the UNFCCC for many years. Her team includes Pedro Brata, who I think is there with you in Florence today. We've also got Nat Cohen's team at C2ES, the Center for Climate and Energy Solutions, helping us to try and design this. We're developing this through a series of focal areas. So the first is a high integrity approach to jurisdictional crediting. This month, we announced that we'll be working with Winrock International to develop the standard that underpins the ETA. Obviously, the crediting standard or the whatever the standard ends up being has to be underpinned by a strong framework for just transition and social safeguards. And Mandy Rambos, now at EDF, formerly the head of Just Transition at ESCOM, and also South Africa's Article 6 lead negotiator, is going to be leading that work for us. So we're very lucky to have Mandy on board. We're working with companies and existing voluntary standards to make sure that we align with them as much as possible. So that includes the Science Based Targets Initiative, SBTI, the Greenhouse Gas Protocol, the Voluntary Carbon Market Integrity Initiative, VCMI, to develop company participation criteria and use cases. Meaning, what are the minimum criteria for a company to be part of this buyers coalition? How can they use any credits generated from the ETA? Are those use cases restricted? And we're developing all of that with those existing standards. Amy Merrill, now at C2ES, recently at C2ES, she used to work at the Secretariat for many, many years, running the Article 6 negotiations, is working alongside GFANS to develop our transaction and investment structure And I think that's really crucial work, because obviously when we're talking about the kind of investment needed for something like energy transition, carbon market mechanisms or carbon credits can only be the sort of frosting layer on a pretty sizable capital stack. And we have to figure out what the carbon crediting element of that capital stack incentivizes, and how all of that fits together while still having environmental integrity and being additional. So in order to figure out how that all fits in the broader context of climate finance and what the ultimate mobilization goal should be, we're also working with Vikram Ridge at CPI to do the finance work. So we've got a huge team working to develop this ETA, because I think energy transition in developing countries is one of the most important things we need to do this decade for climate action. And I think there's no reason why carbon pricing or carbon market mechanisms, as we used to call it, wouldn't be a big part of that, wouldn't have a role to play. So once all of these components are more advanced, our hope is that the ETA can serve this as a component of the broader climate finance strategy to accelerate the clean energy transition. For instance, by providing a predictable revenue stream so that the ETA can unlock more favorable upfront finance. So it could de-risk that finance or unlock the kind of finance that we need to really get that energy transition moving at the scale that the IEA, for instance, identifies. So right now we probably have more questions than answers ourselves, but I think it's an exciting initiative and a really important one, and one that we're really spending a lot of time and effort on. So thank you for having me today, and I'm very jealous not to be there in person.
Thank you, Kelly, and we will warmly welcome you next year to the next edition of Climate Week, and we sense the excitement. I think it's clear that we need a diversity of approaches on carbon pricing. There is no one-size-fits-all. Also very good to hear that you are working on the basic principles like high integrity, additionality, etc. But indeed also still lots of questions that we get from you, and I'm sure this is the same for every new initiative in the field of carbon pricing. So that's something we all experience. Thank you, Kelly. And please be with us in case there are questions from the panel. Let me then turn to Guy. Guy, you have many, many years of experience as an analyst and a strategist following all these initiatives and all this work. What does all this inspire you? What do you draw as lessons from this, and where would you recommend we go?
Oh, that's a big question. I would firstly like to thank yourself and Jos, and echo Kelly's comments about the special place that we have here, and thank you and for being part of Jos's magic, as was mentioned first. It's really quite humbling. I come here once a year and recharge my European batteries, which get depleted too quickly now in the UK. And after sort of a day and a half of listening to the energy, the enthusiasm, the commitment, and wisdom of everyone here, I think living in the UK, you don't know what you've got till it's gone. And I actually think the majority of people feel like that. So there's a lot that we can learn. And I will try and sort of take back to my humble little group in the UK. Well, though we are a global company, it's fantastic to be here. And I love the energy and the optimism of it, and the intellect. So I've got a few comments on the VCM. It bubbles up in several of the conversations. I spent more than 15 years of my life looking at compliance markets and working with Jos and the team on EU ETS, and before that the UK ETS. I was a compliance guru, a sort of geek, not a guru, a geek, and everything to do with compliance. And then something changed in 2020, and voluntary action suddenly became really important. And I was fascinated by this. I was fascinated by the origins of it. it's very difficult to put your finger on. The business of business is business was the previous mantra. If you want business to do anything to deal with externalities, you're going to have to regulate us. Yes, there have always been, over the centuries, there have been benevolent businesses that treat their workers incredibly well, have a very sort of responsible attitude. But this was this really was a very rapid transition where net zero started to become very common, those commitments, and I was fascinated as to what was driving it. And so we started to collect some data, and I'll show you some slides. And I also want to touch on CBAM and the link between CBAM and the VCM. So just some quick stats. We characterize the state of the carbon market, the voluntary carbon market, as a set of headwinds, crosswinds, and tailwinds. I had to insert crosswinds because there are things blowing in both directions, and we don't quite know where they're going to go. The headwinds will be fairly common to everyone at the moment. The ongoing geopolitical tensions, the Ukraine war. We've got macroeconomic challenges, partly driven by that event in Ukraine. ESG investing pressures in the US, so DeSantis banging his drum about the business of business is business. And not least the carbon credit quality issue that's been very much in the media, and the ripple effect that's had on some buyers and some supply side operators as well. The crosswinds I put down as being those issues around carbon credit quality are being addressed. I think various other people have spoken about them. We've got the Carbon Credit Quality Initiative, the ICVCM, the Integrity Council, and even the registries themselves and standard setting bodies, and the developers of carbon projects now coming out and saying we are changing the way we're doing things. That transition, that change, all of those initiatives are going to create some volatility in volumes and in price whilst those systems are bedded down and improved. So in the medium term, short to medium term, that's creating some vortexes in terms of these crosswinds. But the long run, as those quality initiatives sort of come through, the outcome should be more positive. But the tailwinds, it's not all doom and gloom. As I said, project developers are actively sort of changing the way they're doing things. Oddly, more companies are still committing to take action on climate change, and I'll show you exactly the numbers in a second. And carbon credits actually remain an important part of voluntary climate action today. The use of carbon credits in Q1 for voluntary climate action on the corporate sector was the same as it was in Q4 last year. Nearly identical number of carbon credits retired. And that's in spite of all of the media stories that you've heard in terms of, The Guardian or Bloomberg or whoever, trying to stick a nail in the coffin. It hasn't happened. Companies are still taking action. There's also a subtext to that, is that there has been a sort of a separation of corporate climate approaches. And what we've seen is an increasing number of inquiries of companies saying, we're still interested in this sector. We want to be guaranteed about what we're buying though now. So they're not walking away, they're just asking much more appropriate questions. There will be some at the bottom that are perhaps saying, this is a bit too difficult, maybe we'll park it for the time being. This chart sort of talks to my last point. So this is the total number of companies under SBTI with net zero, with commitments under the SBTI, Science Based Targets Initiative. The left-hand one is cumulative. The dark purple are 1.5 degree targets. The SBTI creates a number of different ways for companies to make those commitments. And so we're up to 95,000 companies with net zero commitments of one form or another. The purple one at the bottom is 1.5 degree, which is like the really sharp one, the one with the 90% decarbonisation target. The one on the right is more interesting, which is the number of companies per quarter setting new targets. And if you look at the dark purple line, 340 companies, new companies, set net zero, 1.5 net zero targets in Q1 of this year. That is 12 months after Russia invaded Ukraine, after a full 12 months of inflation ripping through nearly every developed country economy, corporate profits being depressed. There's something really interesting going on here. Yes, it's long term. These are 20, 30-year commitments. But I think it shows, there's been no reduction and dilution of interest or commitment. certainly from those statistics. And you can see some of the companies that made commitments in Q1, KPMG, I'll ignore Red Bull, but NL, Dow, Lenovo, some really, really great companies. On the volume side, the issuances, there was a sort of interesting spike of issuances of carbon credits from all the registries. This is the top 10 registries. And Q4, there was a big spike. That was actually because we started to evolve this jurisdictional, so national level crediting of forest projects around the world. And that's put a spike in Q4 last year. But there's a very interesting, broadly a peak in 2021, but has come down a little bit since then. What's more interesting is retirement. So this is the rate at which companies are taking offsets out of the system, retiring them so they can't be used by any other company. And it's a lower volume. So there is more issuances being created than are being retired. But if you look at Q1, this sort of 2023 compared to Q4, it was identical at 48 million tons, which no one would have predicted if you'd read the media. It's held steady. It hasn't increased. We were predicting sort of 40-50% growth year on year if you sort of trace this back to 2020 or 2019, and it has plateaued, but it hasn't fallen back. And I think that's a really sort of interesting pattern. One consequence of the greater issuances than the retirements is this accumulation of surplus. So in the registries, there are now 812 million tons of carbon credits sitting in registries that are issued, haven't yet been used. Now, the color coding, the green ones are forest-based, dark green are REDD+, so avoided deforestation. Light green is afforestation, so growing more trees. Gray is renewable energy. The dark purple is non-CO2 gases. And purple is energy efficiency, largely cook stoves, actually a lot of cook stoves. And so there's a big spread of project types, but there's this overhang of credits, which some of them extend back to 2010 or so. So some of them are quite old. Now there's a question about whether all of those will ever be used, whether they're desirable, because it's the claim that's important here. Because they're not a compliance instrument, it's a reputational enhancing tool. Whether companies will be comfortable with claiming a credit that happened 10, 12 years ago. And we have seen a recency bias that companies wanting to use more recent credits. This is the average price, the global volume-weighted monthly average price of carbon credits in the voluntary market since Q3 21. And you can see it peaking in Q1 22. This is an aggregation of a lot of data and that we collect from over-the-counter transactions and exchanges. And it has come down a little bit. But the interesting thing for me is if you look at the trend over the second half or the last quarter of last year, Q22, and the first quarter of this year, it's come down from about $6.7 to $6. And again, that's not what you would expect to have seen if you'd read the media of doom and gloom, the Bloomberg, the Guardian, and some of the other rhetoric that's been circling around. And part of the reason for this is this flight to quality in some parts of the market. Companies paying really high prices for exclusive credits. So high quality, interesting boutique credits, maybe mangroves, and projects which have additional socioeconomic and environmental benefits. And you can see this on the chart, which is the explosion of those projects by the prices by project type. And so we weight these, we volume weight them. These explode into even more detail, but this is the sort of the one that makes most sense. And the light green is afforestation, costs more to actually buy the land or rent the land, go out, plant the seedlings, grow the trees. Trees don't actually grow that quickly, surprise, surprise, and they absorb carbon relatively slowly, so cost is quite high on a per ton basis. And then the renewable energy, non-CO2 and fuel switch and energy efficiency tend to be sort of bundled at the bottom. Although the pink one is where cook stoves have now started to separate, in developing countries, have separated from other forms of energy efficiency. So there's quite a big spread up there between $12 and $16 a ton for the high quality nature-based ones and $4 to $5. Now I think it's been said several times and quite correctly that $4 to $5 a ton isn't going to save the planet. if you've got $100 a ton in Europe for representing the marginal cost of decarbonization in the EU ETS, really is there an equivalence between that and $5 a ton for what we're getting in the carbon market? I would say probably not. I don't think that equivalence is guaranteed at these levels, and it comes back to some of that surplus, some of the legacy issues that we are having to deal with at the moment. What we also did was we have a quarterly seminar, a webinar, where we asked hundreds of people who turn up, what do you think the price of carbon credits is going to be at the end of the year? So whilst we have our crystal balls, the wisdom of the crowd is also very interesting. And anyone who studies markets will know that actually often the crowd is more accurate than an individual analyst. So on renewable energy, clean cooking, and red and nature restoration, this is the prices on the x-axis and the percentage distribution on the y. You can see that the two colors are the webinar we ran in January, and then the webinar we just ran a few weeks ago. So you can see the difference. And you can see the distribution is renewable energy is regarded as pretty low value because of in a lot of those legacy ones. Clean cooking, we've got $7 to $10, sort of median. Red plus, about $10 to $11 by the end of the year. And nature restoration in sort of $14, $15, $16. And that's what the crowd, that's what over 450 players in the market collectively said that's what they think those prices are going to be at the end of the year. And we also asked what would be the premium. So if anyone's heard of the Integrity Council on Voluntary Carbon Market and the work they're doing to shore up the quality, what we may end up with is a different set of criteria linked to the credits that have those criteria, those standards. And there will be a premium attached to those, and those could add another $2 to $5 a ton on top of what we've already seen. And finally, I wanted to come back to this point that I made yesterday in the session about the affordability of these voluntary carbon credits and the difference between a compliance-driven market where you can get hundreds of dollars a ton because you let the price float according to the target you've set, and a voluntary scheme where budgets start to become much more of a driver of dynamics and prices. And so this chart shows from the end of last year, we've updated it just recently, 3 lines showing the demand for carbon credits if you add up all the voluntary climate commitments from every single company. And this excludes CORSIA, national, and compliance schemes, so it's just the corporate voluntary sector. And if you read this goes up to 2050. By the end of 2050, if you add them all up and you assume that companies follow through on those commitments without any budgetary constraints, you end up between 2 and 6 to 7 gigatons of demand for voluntary carbon, unconstrained by budget. And if you then map that onto the corporate profits, that's what the shaded area is. The bottom of it is a continuation of 0.5% of corporate profits, earnings before interest and tax, from the top 2,500 companies in the world, and then you can see the 1% and then the 2% dotted line. So between the 0.5 and 1% of corporate profits devoted to buying carbon credits at an assumed price of $30 a ton, we could get up to between 2 and 4 gigatons of demand for voluntary carbon. We're not there yet. We're much, much more, much, much lower. But that's what it would cost. That 4 gigatons in the medium scenario is just under 10% of world greenhouse gas emissions. That's a pretty significant chunk. International aviation is about the same, bit less than that. So what it would take is just the top 2,500 companies, if they put between 0.5 and 1% of corporate profits before interest and tax aside for this, at $30 a ton, we can move the needle. I think one of the questions I have is, will shareholders allow that? Is it feasible? My view is, it's a small price to pay. But then that's me sitting here, not sitting in a shareholder's position. And then just finally on CBAM, I just wanted to say the overlap between CBAM and VCM. I describe CBAM, no one's used this term yet, but for me, it's the most insignificant instrument that we've seen since the end of the Kyoto Protocol, because it provides the connective tissue between all the fantastic national schemes that you set, that you identified in your work, and it explains to the rest of the world that these systems are connected, and here's the tissue that connects them. What happens in Europe has direct consequences elsewhere. So there is connectivity between it. And for me, that's an incredibly important message. We're not isolated anymore. We are connected. And I would see it being valuable for that reason, not ignoring the challenges in leakage, accounting, measurement, and all the other challenges that we have. But I think it sends a really important signal. And then in terms of the VCM, the question that's been posed to me sometimes is, will it displace voluntary action? If we expand the range of regulations, does it cannibalize voluntary action? I don't think it does, because even the SBTI says that if you're going to decarbonize to net zero and reduce by 90%, there is a very important role to play, because you're still emitting 99% in the first 10 years. That needs to be offset at the same time as investing for the longer term decarbonization trajectory. And if carbon credits can be used in some way to be part of the CBAM accounting mechanism, I think they can. They would need some, perhaps, compliance backstop, like a corresponding adjustment that made sure that the integrity of the entire system is maintained. So I think there are mechanisms to include credits within the CBAM, and I don't think it displaces voluntary action.
Wow, thank you very much, Guy. This was really very, very interesting. I think we can fairly say that you have evolved from a compliance geek to a VCM guru. Okay, a VCM geek. Let's conclude on that then. Now, this was really very interesting, and a lot of food for thought, and also food for reflection as part of regulators, what we should do or not do to make sure that that potential really is realized. So, colleagues, friends, lots of stuff here for questions and comments. So this is the moment to turn over to you and invite your comments, your emotions or perplexities when you hear all this. So who would like to break the ice? Yes, please. Maybe the microphone is coming.
First of all, thank you very much. Extremely interesting, I must say. I had a quick question or two questions to Guy. If you looked at the supply side of voluntary carbons, you said went up to 280. There was a slide where you had this backlog, but then you saw the volatility of the pricing was not that extreme, I would say. There was not a collapse of pricing because of this high supply. How would you explain that? I mean, first question. And then the second one is that, have you looked at the consequences of regulations? And I'm thinking of a recent one that the Commission issued, the CSRD, if I'm not mistaken, where there is a kind of transparency request for carbon planning, etc. Probably this will be part of it. Have you looked at the effects of this regulation on the voluntary carbon market, or is this too early at this stage?
I'm really happy you asked that question. There is more regulation coming. We also have proposed a Green Claims Directive, which would empower the Commission to come forward with a delegated act on rules for carbon credits or offsets. So how will all this help?
I think we need to see the whites of the eyes on those things. Are the consultation documents out? Are the proposals out?
The proposals are out, yes, yes, yes.
I think we need to take a close look at those. The devil will be in the detail. And we may be producing some formal response to that. But to your first question, it's a great question, because we keep looking at this, and coming from a sort of commodity markets background, I told my analyst, run an econometric model that says, as the surplus increases, presumably the price is going to decrease. Every other commodity market, oil markets, when inventories increase, prices decrease. One lags the other. One is a leader, one is a lagger. It's the standard things, because you've got more supply. And they came back to me a few days later and said, Guy, it doesn't work. The prices have gone up as inventories have gone up. It's the only market I know that's ever behaved like this. So the surplus does, you can't avoid the basic intellectual sort of position that the more volume there is, the lower the price is. And it does eventually weigh down on price. But it's a very subtle effect. It's not a one-to-one or a very positive relationship at all. We had a period in last year where the inventories were just building and building and prices were going up, particularly in forest-based projects. And what's driving that is a particular appetite for certain types of projects. And that appetite is overcoming supply. And not all of the supply is being bought. So some of the older stuff is just sitting on the shelf and it's not desirable. And it's not a commodity either. Although I produce an aggregate sort of price, it fragments very quickly. And it's fragmenting even more because buyers are now saying, we're not drawing an equivalence between that project and that project. We want to understand the characteristics in detail of those two projects, even though they look similar. So it's very much a project-driven market than a commodity. And this is one of the challenges in terms of like scaling it and commodifying it. It's sort of we've gone into a sort of reversal as these quality issues have come up. Still appetite for the project, but they want to understand them in a lot more detail.
Then for this to become a business, you need to defragment this market, otherwise you won't have that
yeah, and I expect it to come full circle because you know the quality standards are improving, and you know, that will build confidence again, and then it can start to become more standardized. And the other sort of, we've seen there are standard contracts that you can trade on exchange, so the GEO, the NGO, et cetera, which are bundled contracts. And they have fallen off in price more quickly than I've shown you on the prices that I showed, because those include over-the-counter transactions as well. And it's the over-the-counter transactions, which are highly specific, that have been more desirable and had higher price. If you go to the bundled contracts, they've fallen because people don't quite trust what they're getting entirely in those contracts.
Okay, so trading and transparency will be very important in this indeed. There's a gentleman in the back there, all the way in the back.
Thanks, Kurt. I'm Jeff Swartz with BP. I have two questions actually, one for Kay and one for Kelly. And my question to you, Kay, was in your travels and activities meeting with governments around the world recently, have you seen any governments that are eager to put forward a new contribution towards their NDC at COP28? And if so, do they intend to use Article 6 to increase that level of ambition if they put forward a target at COP28, just building off of your three themes of what countries should do? And then if I may, Kurt, ask a question to Kelly just about the ETA. It would be interesting to know, Kelly, if the US government is considering applying corresponding adjustments for credits that come from the ETA, and if so, how have you explored that? And if not, what's the latest thinking on that, if you don't mind sharing? Thank you.
Thank you very much. Let's maybe first go to Catherine and then Kay. Or Kay first and then Catherine.
Thanks, Jeff. I wish I could tell you that, yes, a lot of countries are really reconsidering their NDCs and increasing their ambition, and they're going to use Article 6.2 to scale up their action. But unfortunately, I haven't encountered that. I think we're at a point where countries recognise that there will be increased pressure on them for ambition, and it's a time when we need to encourage them to think more creatively about what ambition can look like and remind them of why we built Article 6. And it was a very painful process, as Kelly recalled. We built that to enable enhanced ambition, and countries are not using it. And you can bet that whenever I encounter a country that says we're doing as much as we can at home, I remind them of the opportunity that Article 6 has available to them. So unfortunately, no, but at the same time, I do sense that countries recognise that more is being demanded of them, and you know, we had this kind of additional ratchet consideration agreed in Glasgow, and some countries have considered that. Some are looking internally. I heard about a country, for example, that said we committed to phasing out fossil fuel subsidies by 2025. We are bringing that forward, and we're going to do it this year. So, you know, other forms of ambition, but we really do need to see the harnessing of Article 6.2. I'll be working on it.
Yeah, just to build on that, Kay did mention earlier the global stocktake, which is happening this year, to see how are we doing in collectively meeting the Paris Agreement. And we know that it's not going to show we're doing enough, and the purpose of the global stocktake is to inform future NDCs. So one of the things we're hoping to see at COP28 is countries coming forward and putting solutions on the table. And one thing we will definitely be there highlighting is carbon pricing and the value from that, and hoping that we can learn from others and their experiences as well in carbon markets and in driving forward ambition, so that it will inform the next round of NDCs. And I think we will go to COP with full recognition of the IPCC's recent sixth assessment, with the urgency to stay within 1.5. And so again, just looking at all those options, and conversations like this are absolutely critical in informing each other as we are looking at our next NDC.
Thank you, Catherine. Kelly, over to you. There was a question to you as well.
Thanks. And I'm going to pick up something from the last question as well. I did raise my silly yellow hand as if I was on a Zoom call, so I apologize for that etiquette. But on the question of corresponding adjustments, and now I'm even more envious of being, I really wish I was there. So Jeff, thanks for that question. I knew that someone would ask me the corresponding adjustment question, and it may as well be you. I don't think we know the answer right now to how or whether corresponding adjustments will apply in the context of the ETA. I think there's still a lot of work and analysis ongoing about how and whether corresponding adjustments should apply in the context of the voluntary use of carbon credits. It's clear, I think, that for compliance use, they should apply. It's about how accounting systems nest together and the appropriateness of that. What we know right now is a lot of developing countries aren't ready to authorize the transfer of carbon credits in the context of voluntary uses. So we're still building out that work, including in that the Guy mentioned the ICVCM, the Integrity Council for Voluntary Carbon Markets. I'm on the board of the ICVCM, as is Jeff Forrester, who I know is just there because he just sent me a picture. I are part of the secretariat for that group, and I'm actually chairing the Standards Oversight Committee. We're also trying to figure out, we've launched a work program to figure out the answer to the corresponding adjustment question. And Guy, when I was still at EDF, Guy did a lot of work for me on that. So I think there's a lot of brain trust in that room working on the question of how and whether corresponding adjustments apply in the context of the voluntary use of carbon credits. And I think I have a lot of confidence that we're going to come to the right answers based on this sort of analysis that's being done. On the previous question, I think it's true that increased demand once we sort out the quality issues, and that's really our focus in the ICVCM. But I think there's also a demand side question that's happening because, when we're talking to companies about how much they would be willing to invest, the amounts are huge, but they need to know that it will count, that an investment in any kind of voluntary action will count towards their targets, because companies are taking these targets hand over fist, but most of them don't have a clear pathway to meeting those targets. Even when they're starting to employ really expensive emission reduction options, they just run out of space to hit those net zero targets after a minute. And they do need they're looking for flexibility. And I think we're all trying to provide the kind of flexibility that really incentivizes private sector investment to the level that everyone's telling us we need. But also, we're all keenly aware that we need to avoid greenwashing and maintain environmental integrity. And I think that's where European legislation can be incredibly important. There is a Brussels effect that is global when the EU comes out with legislation. So people are watching that space incredibly closely. And they tend to build on the sort of voluntary standards. that become quasi-regulatory, in particular in the United States. So that's the Science-Based Target Initiative, underpinned by the Greenhouse Gas Protocol. And I think we're seeing movement there. They're looking at beyond value chain mitigation guidance. And then we have this voluntary carbon market integrity initiative that is really looking to define high quality use of voluntary carbon credits and potentially even a broader array of market mechanisms. So thanks, sorry for answering the first question as well, but we're very closely involved in all those initiatives, so.
That's great, Kelly. Thank you very much. And indeed, the Brussels effect does exist, and I think it's also in some parts thanks to the brain trust, as you say, that is in this room, that the Brussels effect has some effect. We build a lot on the exchanges like the ones we are having this week in Firenze. Any other question or comment from the floor? Yes, Arthur?
Arthur Metzger. I'm with the Mercator Institute and formerly Commission official in DG Klima. And I have a question to Guy. Apart from the thousands of companies who have net zero commitments, there's also 120 parties to the UNFCCC who have net zero commitments. And I think all the calculations are showing that they will need one of your subcategories of offsets, carbon dioxide removals. And the estimates that have been done, it is in 2030 probably already around 2 to 3 gigatons. And in 2050 it could be up to 10 gigatons per year. So how does that interfere with your calculations when you look at the voluntary market? Because I think those two will be somehow in competition. And is that not going to change the picture dramatically?
And if I may take the liberty of piggybacking on Arthur's question, there's also an increasing interest for biodiversity financing following the COP15. And those constituencies are also looking at voluntary carbon markets as a possible source of revenue. Is that another possible complication or competition, or is that helpful? Over to you, Guy.
Okay. On the first one, yeah, the interplay between removals and reductions is hotly debated. I think there's been a bit of a misunderstanding and a sort of extension of the argument. So the removals activity that's going on today is very much focused on very expensive, laudable, but expensive technology. So biochar, direct air capture, bioenergy with CCS, enhanced weathering. Fantastic projects. They relatively sequester modest amounts and at pretty high cost. Now the idea is that some of those costs will come down. But all the modeling that we've done says that they will not come down to the point that they will be scalable to be able to deliver the size of the volumes that you've just said. And if you are looking at removals to deliver 4 gig or 10 gig, you're looking at geoengineering at that scale. And that's a word that nobody's been talking about for the last 3 or 4 years. And I think the reason is it's quite scary when you think of geoengineering. It's very unlikely you're going to get 5 to 10 gigatons of direct air capture with electricity, powered by electricity. There will be a need for removals at a modest scale because they're desirable. They've got a lot of great qualities, but the scalability of them at the level that will make a meaningful impact on the concentration of CO2 in the atmosphere is a long way off. And there will be more cost-effective ways of delivering that through emission reductions. So it's going to be a complementary approach, I think. But I think we need to be very mindful of assuming we can get out of jail at the scale of 5 to 10 gigs with removals, doing the job of reducing emissions. There will be adverse consequences. As regards to biodiversity, yes, I'd love to be able to bundle biodiversity. I think the carbon credit has been a Trojan horse for that interest group. I think that it's easy because you have a natural forest and it has fantastic biodiversity benefits. If you're valuing the carbon credit, there's been the difference between a project which just reduces carbon and one which has a lot of biodiversity benefits is huge. And I actually think we'll see the evolution of a separate market for that. I don't think it will piggyback on the carbon credit because there's too much other value being created. It's too special. And there are a very large number of other ways of reducing carbon in the atmosphere. And yes, it's helpful to have that as a single reference point and you tag on additional attributes. And there are SDGs, the market does react to that. But if the interest in biodiversity and the targets that companies are now setting and media interest in that area grows, I expect we might see a separation.
Stefano?
Just adding quickly on what Guy said, and I fully agree with that. And also to get back to Arthur's point, I think, pretty much will also depend to what extent the two systems, so the voluntary market and crediting for removals and compliance markets will continue to exist as two separate systems, or to what extent they will converge over time, because to a large extent what Guy showed on the slides fully concern the voluntary market, and so far other than the cases that you pointed out, such as Corsia, Colombia and South Africa, there's not much of a compliance market for international credits, but that might change going forward, and it's really down to eventually the decisions that governments will take as to what role they want to give to their compliance systems and to what role they want to give to removal credits in the broader NDC achievement. And one option, not necessarily the option to go for, but one option would be to progressively converge the two systems and over time turn the emission trading systems and the compliance instruments that we have today to systems that can effectively balance leftover emissions with an equivalent amount of removal credits as a way to contribute to bringing the overall emissions to net zero. That is one option. The other option is to keep them separated, and you also have other shades in between. But I guess answering Arthur's question really has to do with figuring out what role and what interplay there will be between the two systems going forward.
Thank you,
Stefano. Sorry, if I could just
sure, go ahead,
add to that. I think there is a really strong connection on the biodiversity point, but to Artur's point, I think one of the things that's been driving the premiums that we're seeing on removals is this notion that people are all going to need removals to cover the residual emissions. But there's also been some misinterpretation of the guidance that the only thing that can count right now is a removal credit rather than a reduction credit. And I think, the problem there is that, yes, we need to take the plug out of the bath, but the tap is still on. So we still also need to focus on reductions. And right now, I think what we want to drive are the kind of removals, the kind of tap removals that create more permanent removals. And there's a lot of interest in nature-based solutions, and that's wonderful. But it's difficult for the voluntary carbon market because of issues related to permanence. 300-year contracts or 300-year obligations to monitor emissions just aren't very compatible with the way that financial markets work. So I think it's a challenge that we're going to be looking into in the ICBCF. But in the link to biodiversity, I think, yes, there is a connection in those safeguards. Guy touched upon it. I think we need to see stronger biodiversity safeguards because of this rush to removal credits. We're seeing a rush to the kind of projects that can really have a detrimental impact on biodiversity. We don't want to see everything mowed down and replaced with eucalyptus farms. There's a limited place for that. We do need to make sure that we're protecting biodiversity in our search for removal. So I think the direct connection is through the kind of safeguards that would say, you know, you need to be mindful of biodiversity when you're investing in a carbon credit. My concern is the building momentum for sort of biodiversity credits, because I'm not yet convinced on any of the sort of measurement or fungibility elements of those that I've seen. And it, you know, creating a credit out of anything, I love environmental markets, but I do think we have to always make sure that we have that kind of integrity right at the forefront. And if we could see methodologies that could produce that, then I'm excited about it. But so far, I really haven't seen that.
Thank you very much, Kelly. And Stefano's comment almost provided us a very natural bridge to the next session, which is about what is next for European and global climate policy, which Jos will moderate. Unless there is someone with a burning question, which I don't think is the case, I would suggest that we close this panel here by giving a warm applause to the panel members for their insights. So thank you very much. Coffee is served outside and we come back here in half an hour. Thank you.